All right, welcome to this explainer. Let's be real for a second. When most people hear the word accounting, they immediately picture endless spreadsheets, complicated math, and just mountains of boring paperwork. But honestly, at its core, accounting is actually an amazing story. It's the story of how a business survives and grows in the real world. So, to make this completely practical today, we're not just going to sit here and look at dry theory. No way. We're going to start a hypothetical business together, right now. Imagine we are opening a brand new mobile phone shop. By the end of this explainer, you're going to see exactly how the money flows through our little shop, from opening day all the way to the end of the year.
So, here's our roadmap for the journey today. 1. Accounting ki shuruat. 2. Accounts are golden rules. 3. Double entry our journal. 4. Ledger our trial balance. And finally, 5. Akhri natija, final accounts. We're going to take this step by step, from the absolute basic foundation straight through to the final scorecard.
Section 1. Accounting ki shuruat. Let's jump right in and lay the essential bedrock for our new mobile shop.
So what is accounting, really? Well, simply put, it's the systematic language of business. Just like you need a language to talk to other people, a business needs a language to clearly communicate its financial health. It's the system we use to record, classify, and summarize every single penny that comes into and goes out of our mobile shop. Think about it. If you buy a batch of phone cases from a supplier, that gets recorded. If you pay your shop's electricity bill at the end of the month, that's recorded too. It's basically how we translate everyday physical business activities into a beautifully structured financial story.
Now, to speak this language fluently, you've got to know the 3 core words of our business vocabulary. First up is capital. Think of this as the initial spark, right? This is the money you, the owner, are actively taking out of your own pocket and investing to start the shop. Second, we have assets. These are the things the business actually owns. We're talking about the glass display counters, the inventory of shiny new smartphones, and the actual physical cash sitting in your register. Finally, liabilities. This is what the business owes to outsiders. So if you took out a small bank loan to buy extra inventory for the holiday rush, that loan is a liability. It's really that straightforward. What you invest, what the shop owns, and what the shop owes.
Section 2. Accounts and golden rules. Now that we know those basic business elements, let's look at how we actually classify them using the magic of debit and credit.
Okay, let's dive into this. The ultimate cheat sheet. In accounting, every single transaction falls into one of 3 account types, and they're governed by what we call the golden rules. First, we have real accounts. These handle your physical, tangible assets, things like your cash and your mobile phones. Second are personal accounts, which deal with the actual people or companies you do business with, your suppliers or maybe your local bank manager. And third, nominal accounts. These track your invisible, day-to-day items like income, expenses, profits, and losses. Think of your monthly shop rent or your daily sales revenue here.
What's just beautifully simple about this logic is how perfectly it applies in reality. Let's zoom in on the real account rule for a second. Debit what comes in, credit what goes out. Imagine our shop buys a brand new batch of mobile phones and we pay in cash. Mobile phones are physically coming into the business, right? So we debit our inventory account. But cash is physically going out of the business to pay for them, so we credit our cash account. You're literally just tracking the physical movement of value step by step.
Section 3. Double entry our journal. With those golden rules safely in our back pocket, it's finally time to open our shop doors and record our very first day of daily operations.
Now, everything we've talked about so far rests on a truly brilliant foundation called the double entry system. Honestly, think of this like Newton's third law, but for finance. For every single business action, there's an equal and opposite financial reaction. You can never, ever just have a debit without a corresponding credit. If you hand over cash to a supplier, well, your cash goes down, but your inventory goes up. 2 accounts are always affected in opposite directions. This is the absolute genius of accounting. It constantly self-checks its own balance to make sure nothing slips through the cracks.
So when these double entry transactions are happening all throughout the day, where do they actually go? They go straight into the journal. Think of the journal as the rough, daily diary of your business. It's the book of original entry. Every single time you make a mobile sale to a customer, or pay a delivery driver, or buy a stack of chargers from a supplier, you write it down right here, chronologically, line by line, as a journal entry.
Okay, so we're diligently writing everything down day by day, hour by hour. But here's the catch. What happens at the end of the month when you want to know exactly how much cash you have left in the register? You can't possibly sit there and read through thousands of mixed-up daily journal entries, manually adding and subtracting cash line by line. I mean, that would be absolute chaos.
Section 4, ledger or trial balance. That brings us perfectly to the next step of our architectural build, where we finally sort all that raw data into incredibly useful information.
This chronological flow is exactly what brings complete order to our mobile shop's finances. We don't just stop at the journal. We take that chaotic daily diary and we meticulously sort it into the ledger. And then, from the ledger, we summarize everything into a trial balance. Let's break down exactly what that transformation looks like in practice.
So think of your journal as a chronological mix of absolutely everything. You got a cash sale at 9 a.m., a rent payment at noon, an inventory purchase at 3 p.m. It's all jumbled together by time. But the ledger, that changes the sorting method entirely. It acts like a stack of neat school notebooks, where each notebook is dedicated to a single subject. You take all the cash entries from the journal and put them exclusively in the cash notebook. You put all the sales entries into the sales notebook. Now, if you suddenly want to know your cash balance, you just open the cash ledger and boom, the exact total is sitting right there.
Once all our specific ledgers have their final totals for the month, we pull them all together into one single summary list called the trial balance. I really like to call this the pre-exam checkpoint. It's simply a master list of all our ledger balances, and it ensures that our total debits exactly equal our total credits. Let me tell you, it's a fantastic moment of relief when they match, because if they don't, we immediately know we made a recording error somewhere back in our daily diary, and we've got to go back and fix it before moving forward.
Okay, so our trial balance perfectly matches, our books are mathematically correct, and our data is beautifully organized. But it still doesn't answer the most burning question of all. After all this incredibly hard work, did our mobile shop actually make a profit this month?
Section 5. Aakhri Natija, Final Accounts. To answer that burning question, we enter the grand finale of this explainer. This is where we take all that beautifully organized data and create our ultimate business scorecard.
So the crucial point here is understanding the difference between these two final reports. The profit and loss account is your performance metric. It looks at your nominal accounts, all those incomes and expenses over the whole month, and subtracts the expenses from the sales to reveal your net profit. It essentially tells the story of the journey. The balance sheet, on the other hand, is entirely different. It's a snapshot of your exact position at a frozen moment in time, usually the very last day of the year. It lists your real and personal accounts, your assets, your liabilities, and your capital. It shows your exact destination today.
And here is the golden rule of the balance sheet. It must always, always balance. Every single asset your mobile shop owns was funded by either money you owe to someone else, a liability, or by money you, the owner, actively invested, your capital. The two sides of the coin are fundamentally linked and will always match perfectly.
Take a step back and look at what we just accomplished together. In just a short time, you've journeyed from a complete beginner to someone who actually understands the entire life cycle of business accounting. You know the language, you know how transactions are recorded using double entry, how they're sorted meticulously in the ledger, checked safely in the trial balance, and finalized on the balance sheet. You've built a remarkably solid working foundation. Which leaves us with this final thought. Accounting is so often dressed up in intimidating jargon, but underneath it all, it's simply a logical, beautifully balanced system of rules and records. It's just tracking the everyday reality of your business. So if the language is actually this straightforward, what is stopping you from mastering your own business numbers today? Embrace the numbers and let them tell the story of your success. Thank you so much for joining me on this explainer, and keep learning.